Good morning, y'all. I wanted to jump in here. I know it's an early Saturday morning. Before we get going, let me just make sure that we are broadcasting live and that everything's coming through. If you can hear me and you're jumping on, let me know. We're going to talk a little bit about money. We're going to talk about taxes. We're going to talk about all kinds of stuff to make sure that you guys are dialed in. Um, Listen, anytime we talk, we're looking at things like let's see if I can get on here and let's just verify that. Yeah, yep, we're live. Can you hear me? Awesome. Um, Good deal. So here's the deal. I wanted to jump in here. We've got this and talk a little bit about taxes and about what's going on and this new tax bill and how it's going to affect you. And then I want to answer some questions if any of you have questions, anything like that. Now, if you happen to be on Facebook and not Instagram, do me a favor. Make sure that you connect your Facebook to Restream to give me permission. Otherwise, you come up as uh, Facebook user, and I want to. You deserve a little more respect than that. So, hello, hello, hello. Let's talk purpose, vision, and strategy. Peter is on the line. So good to have you. Well, Peter, we can chat about that. The first thing I wanted to really start to talk about, which is going to affect all of us, is that we're going to have some tax changes coming down the pipe. We don't exactly know what they are, but they're going to affect pretty much everyone. I know that they're saying that it's only going to affect the wealthy, but let's just look at it real quickly. I want to just kind of cut through all the craziness and everything, and just look at what's the House bill, the thing that the Democrats have proposed. Now, this is totally about the economics. It's about the money. It's about the taxes, and it ain't about the politics. All right. So I don't care what side of the aisle you're on. That is for you to decide. I'm just going to talk about the tax bill as they've proposed it. Here's the good news. It's not as bad as they originally thought. What we had anticipated coming down the pipe was some big tax increases, some elimination of some big deductions and things like that. And the reality is that's not what's happening here. Is that there is tax increases nonetheless. In fact, anytime there's an administration change, you can anticipate that there's going to be a tax change that comes along with the administration change. So we had an administration change, and President Biden and his on his platform said we were going to focus on green programs and social programs. And in order to pay for those green programs and social programs, we're going to have to do some things with taxes. Now, one of the things that they need to do is it needs to be a neutral bill in the sense that if they're going to pay for infrastructure, and this is a $3.5 trillion proposal. If you look at what has come down in the last 18 months, that's going to be about $10 trillion. So it's a big number, but this number needs to be balanced. And so how this is going to play out, just so you know, is that it's been proposed by the House, which is primarily the Democrats, has proposed it. And I say it's primarily the Democrats, not for any other purpose, but to understand that this is the first offer to the Republican side. So the likelihood that it's going to be worse than this is low because this is their first offer. And so the House will has it for a couple weeks. They're going to have to approve it. They're hoping to get something done by the end of the month. I don't know. It's an 881-page bill. I have not gone through all of it. I've gone through some of the major components that can affect us and everything. The Senate has to look at the bill, and the Senate and the House need to reconcile the bill. So in that process, things are going to change. So whatever I tell you here is where we're at today based on my interpretation. Now, based on the negotiations and the back and forth, what ultimately gets signed into law is going to be different. But let's just understand where they are. And I took a bunch of notes on it. So I'm going to, if I look down, to make that happen. And I think that if there's any issues with this, and I think that there's one major issue that I think we all ought to get involved in. It doesn't matter. It doesn't matter what side of the aisle you're on. That I'll talk about. But here's the bottom line: is that when we talk about taxes and everything, this is the rollout of the biggest legislative package in years. It's missing a lot of the tax hikes that were promised during the campaign, which is good and bad. As the problem is that are the taxes being used effectively? That's a whole nother discussion for another time. But the idea here is this. Let's just look at some of the provisions. The first thing, which was one of the big deals, is capital gains. So capital gains, just so you know, is typically a lower tax rate for people that hold assets. So if you buy stocks, if you buy property, and you hold it for over a year, then the capital gains rates, you'll pay at what we call capital gains rates. And if we look at capital gains rates, then your capital gains rates currently are $0 to $40,000 in income. You pay 0%. So if I had no income and I sold stock, if I had zero income and I sold stock that I held more than a year, and I made, say, $35,000 on that sale of that stock, I pay zero tax. From 40 to 440,000, you pay 15%, and from 440,000 on up, you pay 20%. The maximum capital gains rate currently is 20%. The current income tax rate is close to 40%. So when you have long-term capital gains, an asset held over a year, you could pay almost half the tax rate. And what the original expectation was that the proposal was going to say, no, we're going to eliminate that capital gains treatment, and now we're going to push it all the way up to the 40%. So it didn't matter whether you held it a year or less than a year, you're going to get hit at your ordinary tax rate. That didn't happen. In this proposal, they pushed the capital gains rate, or at least they're proposing to go from a maximum of 20%. They're saying they can't hear my audio. Let's just see. Virtual cam audio. Let's do this. Let me see if you guys can hear my audio now. Let me know. So here's the thing. They propose to push the maximum from 20% to 25%. Now you guys can hear me. So here's the deal. So they push it to 25%, which is not bad, but it still hurts. If you sell $1 million asset, another 5% is still going to cost a fair amount, but it's not 40%. Now, this does include what happens at the state level. Here's the other thing with the capital gains rate. There was discussion that the capital gains change was going to be retroactive to the beginning of the year. That's not the case. The capital gains will rate, whatever it does, will take effect as of the date of accepting this proposal, if you will. So it'll be sometime between now and forward. So if you're in the middle of a transaction, if you're in the middle of a deal, what you want to do is make sure that you have your deal contracted before this act goes into place, because then you'll fall under the old rules. So hopefully that makes sense. And so the idea here is this: is that the capital gains is going up. The maximum it'll go up, it looks like, is going to be up to 25%. It's not going to be retroactive, which is good. The other thing is this: is that they left alone. They were going to do, there's something called 1031 exchanges, where if I own a piece of property, a real estate, that is an investment property, and I could sell it. And turn around and buy a new property within a specific time frame, we exchange properties basically. And as long as I buy something of greater value in general, then I don't pay any tax on the first sale. I pass the tax to the second sale later on. It's called a 1031 exchange. And there was talk about them eliminating that, and that didn't make it in the proposal either. So that's a good thing for investors and real estate folks alike. And so the 25% capital gains rate is going to apply to incomes above $450,000 if you're married, $225,000 if you're single. And so that's the capital gains rate. Let's talk about business for a second. In the business side of it, you're looking at the corporations. Now, these are C corporations, not S corporations. These are regular corporations. What happened under the Trump era is that they went to a flat tax of the corporation at 21%. Where what they're proposing now, they were proposing to go higher, but to 28%. But what they've done is gone to a graduated scale, or they're proposing to go to a graduated scale, paying 18% for anything $400,000 and below. So if you net after expenses $400,000 or below in a C corporation, then you'll pay 18%. From $400,000 to $5 million, you'll pay 21%, and above $5 million, you'll pay 26.5%. So it didn't all the way get to the 28%, but it got close. And they went back to a graduated scale that's in place. Now, the big change is that they cut the tax rate for us as individuals to the maximum tax rate to 37%. In this proposal, they're going to push it back up to 39.6%. 39.6%. So our individual tax rates for high income above $500,000, actually in this case, then you'll be at 39.6%. But for ultra income earners, for big income earners, 5 million and above, there's going to be a surtax, an additional tax of 3%. So they're going to add an additional 3% on that. So it puts you up to 42, almost 43% on that to make that happen. Now, here's where I think we get hit, no matter what your income level is and no matter what your asset level is, and that is in the Iras. Okay, they want to eliminate what's called self-directed IRAs. So right now, when you put money into an IRA, most people will invest into an index fund, an ETF. We talk about that in the Affluence Blueprint and in some of my other stuff on the show. But there's something called a self-directed IRA, where I can take the money, put it in my IRA, and I can buy other assets. I can buy rental real estate. I can put it into an LLC or private companies. I can put it in an LLC that buys crypto. I can put it into other assets, which allows you to diversify your portfolio and do the things that maybe you want to do. Maybe you're not a person that likes the stock market. Maybe you're someone that actually prefers real estate and you want to put in real estate. This proposal would eliminate your ability to do that. And so it is something that this is personal opinion, I'm not for. Okay, I truly am not for it. I have written letters to my congressman. I'm hoping that you will. If you want to do it, there's a section. You want to tell them to remove section 136312, 136312. I'll post it in the comments. And 138314. Tell them to leave your IRAs alone so you can invest it the way you want to invest it. That's all it is. It's not changing the taxable, the tax deduction or anything. It's tying your hands on to how you can invest your money. And I think that you should have the ability to invest the money as you want. But you make that decision on your own. That was my personal opinion. I'm off my soapbox. But that's one of the things that they've done. They also are going to eliminate something called backdoor IRAs. Backdoor Roths. So a Roth IRA is something that you can make a contribution to. You don't get a tax deduction currently, but when the money grows tax-free and you take the money out when you retire, it's completely tax-free. Anyone can make those contributions, and right now, if they're backdoor Roth IRAs, you're limited to $6,000 a year, or $7,000 if you're over 50 years of age. But there's an income limitation on it. If you earn over $208,000 as a married couple, you don't qualify to do a Roth IRA. You can't use the Roth vehicle directly. It's $140,000 if you're single. So there was something called a backdoor Roth, where you would make a contribution to a regular IRA and then immediately convert it to a Roth IRA. It's called a backdoor Roth, and they're going to eliminate that in this proposal and take away the ability to do that. Now, there's something else that hits us, and I'll finish up with one other thing and then see if there's any questions. There is currently a rule for high income earners that will put an additional tax on your net investment income. That means capital gains, dividends, and interest, those kinds of things. Not your wages, not your business income. And there's an additional tax of 3.8% for high income earners. Well, what they've done in this proposal is they've now broadened that tax. It's not just on high income earners with interest, dividends, and capital gains. It's also on business income that passes through. So this NIT tax, called NIIT tax, is 3.8%. If you have an LLC, a partnership, or an S corporation, and it's passing income to your personal return, which is what it would do, it now could be subject to this. If you have a high enough income, it could be subject to an additional 3.8% tax. So watch what happens. They increase the tax to 39.6. If you're a high income earner, you get an additional 3% on that. If you trigger the NIT tax, you get an additional 3.8% on that. So call it 6-7%. So you could be at a total tax rate of 47% on a marginal basis, not from dollar one, but on a marginal basis. So taxes are going up. Now, there are some other things with the estate tax is going to get changed. They want to have that. It's currently lifetime exclusion of about 11 million. They want to bring it down to 6. They're not increasing the rate. So it's not going to go up as far as the estate tax rate. So that's good. And they're going to leave in place something called step up in basis, which is helpful for estates that have illiquid assets that might need to sell them and not incur a tax on them in doing that. So that was good. And then the last thing before I close this out is this, and I know I threw a lot of information at you. I just wanted to get this out there, and then I can answer questions as they come in. Is they're allocating $79 billion towards enforcement tools for the Internal Revenue Service. What does that mean? That means, in simple terms, more audits, more accountability, more audits. Now, that brings me to one other thing. There is also in front of them a proposal that's going to require community banks and other financial institutions to report any transaction $600 or more. This is something that I think is intrusive, cumbersome. It's going to be, so imagine this, that you go and you pay someone with PayPal, Venmo, or you swipe a credit card, and it is above $600, and it's personal accounts and business accounts, investment accounts. The bank is going to report that transaction to the IRS. I think it's far-reaching, overreaching, and that's another thing that I've written the Congress folks about, saying, hey, I want to maintain my privacy in my bank accounts, and the only thing that's supposed to be reported is taxable transactions. So I think you want to be aware of that. I can post some information of that below here if it interests any of you. But know that compliance is going to go up. They're going to get $79 billion under this, the way it's written, to help with enforcement tools with that. So that's what I have. It was a lot of information in a short period of time, but hopefully you'll find it helpful. And if you have questions, if anything comes up, let me know. All right. And And just so you know, a couple things I wanted to let you know about coming up. I want you to mark your calendars for October 28th. October 28th is going to be the world premiere of the Affluent Entrepreneur Live. It's going to be a 3-session live training series with me about money, wealth, life, business. We're going to walk you through the process so you can become an affluent entrepreneur to create the financial independence and freedom that you want. And then the other thing to do is this: is that if you're dealing with money issues and you're trying to figure it out, and you want some help with it, I've got a free 7-day workshop, 7-day workshop free. If you just go to the moneyworkshop.com, those of you have an Instagram, it's up in my bio, but it's called the money plan workshop.com, the moneyplanworkshop.com, and join it. 7 days for free. I walk you through everything from money mindset, debt, scaling your income, those kinds of things to try and help you out. So I hope that this was helpful on a Saturday morning. It was a lot of technical information, which I don't like to do, but it's important that we understand that we have a partner in our bank accounts, and that is Uncle Sam. That is our taxing authorities. And so it is important for us to be able to manage through the taxes. I get that you don't want to be tax attorneys and tax accountants and all of that stuff, but if they have the ability to take 47% of everything you earn, you ought to maybe pay attention to it so we can reduce their access to your wealth and doing it the right way. See, you have an obligation to pay tax. Some would argue that, but you have an obligation to pay tax. You just don't have an obligation to pay maximum taxes. Legally minimize your taxes, all right? And let's maximize your wealth in the process. I hope that helps you, and you guys have an incredible rest of the day, and we'll talk soon. Let me know if you have got questions or anything. Post them below, and we'll make this happen. Cheers.